There is a $1 trillion market currently running the world, but most people have no clue it exists. It decides whether your mortgage gets more expensive, whether Bitcoin pumps or crashes, and whether your country's economy will survive or collapse. It's not stock, it's not crypto, it's the bond market. And if you don't understand bonds, you will never truly understand money. But stick with me because I'm going to explain it so clearly that even a 10-year-old could teach it by tomorrow. Let's make you smarter than 99% of investors in 10 minutes. Imagine this, your friend wants to start a pizza business. He's got the oven, he's got the recipe and everything, but he has no money to buy the ingredients. So he asks, can you lend me $100 to get started? And you agree, but you say, sure, but in 1 year, you pay me back $110. And that extra $10, that's called interest, your reward for taking the risk. To make it official, your friends gives you a piece of paper that says, I promise to pay you back in 1 year $110. That piece of paper is a bond, a written promise to pay you with interest. So what is a bond? It's simply a loan, but instead of lending to your friend, you are lending to a government, a company, or even a city. They borrow money from people like you, and in return, they issue a bond, a formal promise to pay it back with interest. But why do government issue bonds? Governments spend a lot of money every day, building roads, running hospitals, supporting schools, and protecting the country with their military. But here's a catch. Governments don't always collect enough money from taxes to pay for everything right away. So imagine this like your own budget. Sometimes your paycheck doesn't cover all your monthly bills. So what do? You might borrow money, maybe from a bank or a friend, just to fill that gap. Government do the same thing. When there is a gap between what they spend and what they earn, it's called the budget deficit. They have to borrow money by selling bonds. And it's not just one country. The United States, the UAE, the UK, and many other countries all borrow from selling bonds. They borrow from banks, pension funds, insurance companies, and even other countries like China, Japan, and Saudi Arabia. China and Japan, for example, own a large portion of the US debt. So the US needs to pay China and Japan billions of dollars of interest every year. So this makes the whole bond market a global borrowing and lending system that helps countries keep running smoothly even when the money is tight. So here are the key terms when it comes to bonds. So let's go back to your friend and his pizza shop loan. One, there is the principal. So that's the amount you lend to your friend. Second, there is the coupon. So that's the extra money that your friend promises to pay you each year for lending him money. In your case, it was $10 a year. Then there is the maturity. So this is when your friend has to pay back the full $100. In our example, it was after 1 year. And lastly, there is the yield. So this is how much return you actually get on your money, and it can change over time if you sell the loan to someone else. Here's how the yield can change. So imagine your pizza's friend's pizza wasn't very good, so fewer people want to buy his loan from you. The value of your $100 loan might drop to $90 if you try to sell it, but it still pays $10 a year in interest. So the new buyer is getting $10 interest on only $90 investment. That means this yield or return is higher than yours. Let's see another example of why bond and prices go up and down. Think of a bond like concert tickets. Let's say that you bought a Taylor Swift ticket for $100. It's a decent middle row seat. Now imagine a few weeks later, Taylor Swift announces a new show but better seats, front row seats, and they are being sold for $100 too. Suddenly your old ticket is not as special anymore. If you try to sell it, people might only pay $80 because they can get a better deal at the same price elsewhere. That is exactly how bond works. When new bonds offer high interest rates, like better seats, older bonds with lower interest rate lose value because they are less attractive right now. That's why bond prices go down when interest goes up. Who would buy your 3% bond when the market now pays 5%? So who is actually in control of bond interest rates? Here's how it works. The US Treasury is like a shopkeeper. They are the ones selling the bonds to raise money. The Federal Reserve, or the Fed, is like the thermostat for the economy. They keep turning interest rate up or down just to keep things balanced. But here's the key. The long-term bond rates, like 10-year or 30-year-old bonds, are not set by the Fed. They are set by the market. That means that big investors like banks, pension funds, or even governments like in China or Dubai decide what kind of return they want before they even lend money to the US. Think of it like the US government is asking for a loan, and these big investors are naming their price based on what they expect inflation, risk, and future growth to be. So even if the Fed lower the interest rates, that doesn't guarantee that the US can borrow long-term money at cheap rates. These investors might say, hold on, inflation is still high, I want a higher interest rate to protect myself. That's why the market and not the Fed controls the long-term bond yields. Now let's talk about who buys these bonds. Who is lending all this money to the US government by buying bonds? Think of it like this. Imagine the US government is throwing a giant fundraising party and everyone is invited. Here are the main guests at that party. One will be the central banks, like the UAE central banks. So they buy US bonds to keep their money safe and stable. It's like a big saving account that earns interest without too much risk. Second, we have the foreign governments like China, Japan, Saudi Arabia. So these countries, they buy US bonds to park their money safely and earn interest as well. Third, we have the big banks and the insurance company. So these guys also need stable long-term investment. And lastly, we have the regular people like you and me. So through ETF, mutual funds or retirement accounts, even everyday investors buy US bonds without realizing it. It is often bundled in your saving. If you're American, it's actually often bundled in your savings or your pension plan. Here's a fun fact. The UAE government holds billions of dollars in US treasuries as part of its national reserves. Why? Because it's one of the safest, most liquid places to store wealth, and it earns interest too. Okay, so now you might be thinking, this bond stuff sounds complicated, but what does it have to do with me? Let's break it down. One is mortgages and loans. So imagine that you're buying a house. If the bond yields are low, banks can offer cheap mortgage rates, let's say 3%. But if bond yields go up, let's say 5% or more, the bank's borrowing costs rise as well. So your home loan gets more expensive, maybe 6% or higher. Think of it like the cost for renting money. When bonds pay more, the rent for money goes up for everyone. The second impact on you will be on the cryptocurrency and the stock market. Investors are always chasing returns. If the bonds suddenly offer 5% interest guaranteed, that's like a safe, easy payday. So a lot of investors will move their money out of risky things like the Bitcoin or the tech stocks or the startups into bonds. The result? The crypto markets will drop, the stock market will fall, and the risky assets will suffer as well. And third is about business loan and jobs. Companies often borrow money to grow, to open a store, hire staff, or build new apps. But when bond yield rise, it costs more for businesses to borrow, so they cut back. Maybe they don't expand, or they just lay off workers. It's a bit like raising the rent on a store. If it gets too expensive, they have to downsize. So why this matters in Dubai or anywhere? Even though the bond auction happens in Washington, the ripple effect reaches your mortgage broker almost anywhere in the world. It will impact your crypto wallet, your job prospects, and your investment returns. The takeaway of this is that when bond yields rise, money gets more expensive, and that affects everything from your home loan to the price of Bitcoin. Let's quickly talk about the yield curve, the normal curve and the curve inversion. First, the normal case. So usually, if you lend money for a longer time, you expect higher interest rate, right? Lending money to someone for 10 years is riskier than lending it for 1 year. Anything can happen in a decade. So normally, a 1-year bond might pay 3%, while a 10-year bond might pay 5%. That's called the normal yield curve. But sometimes, like right now, we get the opposite. Short-term bonds start paying more than long-term ones. A 1-year bond pays 5%, but a 10-year bond will only pay 4%. That's called a yield curve inversion, and it's actually a red flag for economists. So why it matters? It matters because the yield curve inversions often happens right before a recession. It has predicted every major US recession since the 1970s, including the 2008 financial crisis and the 2000s dot-com crash. So let's talk a bit about the US and its debts. The US owes over 36 trillion in debt. That's trillion with a T, more than the entire GDP of many countries combined. But here's the scary part. A big chunk of that debt is short-term, meaning it comes due very soon, like every few months. And when it does, the US has to refinance, basically reborrow that money at whatever today's interest rate are. Imagine that you had a mortgage, but instead of locking in a 20-year fixed rate, you had to refinance every 6 months. And the bank says, hey, rates went up, now you owe us double in interest. And that's exactly what the US is facing. But why this gets dangerous? If interest rate stays high, the government has to pay way more just to cover interest. We are talking about hundreds of billions more per year just on interest. And if that happens, the government has 3 bad choices. One, they could cut spending on healthcare, education, defense, or social programs. Second, they could raise taxes, which nobody likes. Or third, they could borrow even more, which just makes the problem worse. And why does this affect everyone, even if you don't live in the US? If the world's largest economy is struggling to pay its bills, it creates ripple effects across global markets, including in real estate, oil, trade, or currency markets. The bonds might seem boring, but they're actually very important to understand. They will impact your mortgage, your Bitcoin portfolio, your job, and even your country's economy. So now you understand what a bond is, a loan. Why governments use them to fund everything from highways to hospitals, why yields rise and fall, and what that tells us about the future, how it all ties back to you right here in Dubai or anywhere else in the world. Because here's the truth: if you don't understand bonds, you will never truly understand money. And now you hold one of the most important keys to understanding money. If this video opened your eyes, smash the like button so more people wake up to this. And if you want to actually build wealth and make smart financial decisions in the real world, not just TikTok money myths, subscribe for more real talk about money and personal finance.